Is the bullish counterattack of Bitcoin too weak? If you're interested in knowing more about this, please keep watching. Bybit is one of the best exchanges I've ever used. It provides great market depth, a smooth user experience, and an impeccable interface. Click the link below, complete KYC, and deposit $100, and you will instantly receive a Bitcoin contract position worth $1,000. What does that mean? By simply clicking the link below, you can claim it instantly. Many promotions require waiting until the end of the event to claim the rewards, but not this one. Once you complete KYC and deposit $100, you can choose whether you want a long or short position, and it will be set up for you directly within your Trust Perpetual Futures contract with a value of $1,000. This is truly a very generous offer. If Bitcoin fluctuates just 10% in your favor, you've already doubled your investment. This is truly unprecedented. Now, let's get back to analyzing the Bitcoin market. You can observe that now. Let's start with the MACD indicator. In fact, some people may think that a golden cross means going long, and a death cross means going short. Am I right? However, this is a standard misconception. A crossover does not necessarily indicate a trend reversal. It only represents a change in trend strength. This is a very common mistake. Many people may believe that a golden cross means a trend reversal, but it's not the case. A golden cross simply indicates a weakening of the bearish trend, and a death cross indicates a weakening of the bullish trend. Now let's return to the divergence analysis we mentioned earlier. We need a golden cross below the baseline to resolve a divergence. So, what are we waiting for? We are waiting for a golden cross. If there is a golden cross, we may consider going long, because the divergence is resolved. However, is it possible that after a golden cross, the price immediately continues to drop, initiating a second wave of decline? This is definitely possible. Therefore, after a golden cross is formed, we only consider going long. But if there is no golden cross, we need to continue waiting for the market to recover. If there is no golden cross, forget about going long, because it's possible that the price will continue to drop, or even a bearish price movement may follow the golden cross. All of this is possible, as we can see from the previous market situation. Right? There was a divergence, followed by a golden cross below the baseline. A golden cross below the baseline. Well, there is no divergence here. Let's find a more classic example. If we get a golden cross after a divergence, it is possible for the price to continue lower. In this case, we have a divergence, right? After the divergence, a golden cross is formed. And wow! The price only makes a slight move up before continuing lower with a second wave, which is quite deep and extensive. Therefore, a golden cross is just one condition we need to see for going long. But it doesn't mean we must go long once we see it. In fact, it could be quite risky to go long at the moment. Now, let's take another look at the current market situation. The market structure is quite clear. We have a head and shoulders pattern forming at this level, and it seems to be experiencing a pullback, unable to move higher. Let's draw the head and shoulders pattern. We will get this pattern here. Okay. After the pattern formation, a head and shoulders, the price breaks through the support and then experiences a rebound. But how can a rebound be advantageous for the bulls? It should have a high trading volume during the first rebound. Do we see high trading volume during the rebound? Currently, we don't see any significant volume during the rebound. Therefore, the reasons for going long are not sufficient for the bulls at the moment. The bullish momentum lacks strong volume during the rebound. Furthermore, the price must return to the support level and break above the neckline. If the price can return to the neckline, then yes, it would be more favorable for the bulls. However, we can observe that the price is now starting to turn down again. After touching the neckline level, it has not found the necessary support and is declining with good trading volume. If the trading volume were weak during this downturn, there might still be some chances for the bulls. Well, it doesn't mean the bulls have no chance at all. However, I believe the reasons for entering long positions at this moment are not strong enough. First, the price hasn't found the required support and hasn't held up above it. It hasn't returned to the upside. The price is not being supported. Second, during the bounce, there was no surging volume. It didn't continue the last long lower shadow. That triggered the market movement. The continuity was weak. Let's zoom in further and analyze at a smaller time frame. By doing so, we can gain clearer insights. From this analysis, we know it right away. We can see that there was support at the front. But the price here did not return onto this line after hitting it. Additionally, the bullish volume wasn't strong. Actually, we can see that the current bullish trend is somewhat weak, especially for the early stage of a bullish market that we were anticipating. It's somewhat weak. After the price increase, there was an immediate pullback. The magnitude of this pullback was not shallow. It was not shallow, indeed. It even broke an important support level that we considered significant. Additionally, the volume during the pullback was not low either. Currently, the bullish momentum is somewhat restricted. So what are the ideal conditions? Let's refer to a specific position. Considering it in a 4-hour time frame, you can observe the situation at that time. After a decline, there was a volume-supported rebound. But the volume when the price dropped was insignificant. Then, the resistance level was hit. After that, there was no significant supply generated. As a result, the price started rising, accompanied by increasing volume. Both the price and volume increased, which is a healthier pattern. Moreover, during the pullback phase, the bearish side didn't show a stronger performance than the bullish side. This is a favorable part for a bullish market beginning, where we can make better judgments and entries. However, currently, I believe the reasons for entering the market are not sufficient anymore. As you can see, there was a significant pullback right after the initial upward movement, and the bulls did not demonstrate absolute strength. They did not. Let's take a look at a smaller time frame. If we examine the smaller time frame, you can observe that we also have a head and shoulders pattern on the daily chart. What about the smaller time frame? We can observe a head and shoulders pattern on the 1-hour chart. 2. Let me draw it out for you. As you can see, this head and shoulders pattern is quite clear, with a decline followed by a short-lived upward movement, forming the head. Of course, this is unfavorable for the subsequent bullish development. After breaking below the pattern, the price has indeed dropped a significant distance, and you can notice that the lowest point is very close to where the lower shadows pullback we mentioned. So currently, it's not a favorable situation for the bulls. Okay. Now, let's take a look at Ethereum. For Ethereum, if we really consider going long, at the very least, we need to wait for it to stabilize above the 1,830 level. It must hold above that level firmly. If it fails to do so, it's not ideal. We are holding. You might say, whoa, the current price is better, but the price difference is slightly more than $20, which is within an acceptable range of error. By holding onto this price difference, we prioritize better security. I believe this is a more appropriate and suitable approach for trading. Okay. All right, thank you. You're welcome. To like and share my videos and subscribe to my channel. Turn on the little bell button to show me your greatest support. Thank you so much. Bye-bye.